So, what if the next big financial crisis isn't brewing in the stock market or with those big banks we all know and, well, know? What if it's hiding in a booming, multi-trillion-dollar market that pretty much operates in the shadows? Well, one of Wall Street's heaviest hitters is sounding the alarm, and we're going to break down exactly why.
And this warning isn't coming from just anywhere. We're talking about people who know the system inside and out, with former Goldman Sachs CEO Lloyd Blankfein being a major voice here. Look, when a guy who ran one of the most powerful investment banks in the world raises a red flag, you pay attention. His message is actually pretty simple, but it's powerful. Just because something's growing like crazy doesn't mean it's safe.
Okay, let's dive right into this. We're going to unpack what this market is, why it's exploding in size, and what all these risks really mean for your wallet. To really get what this warning is all about, we first have to get a handle on the market that is everyone talking, private credit. So what on earth is private credit? Well, at its heart, the idea is actually super simple. Think about it like this. Usually, if a company needs a loan, a big one, they go to a bank, right? Or they issue bonds on the public market. Private credit just skips all that. Instead, companies get loans directly from huge investment funds. It's way faster, it's more flexible, and it all happens away from the prying eyes of the public markets. And that massive, massive growth is exactly where our story starts to get complicated. Because you know the same, with every boom, there's always a potential for a bust, and that's usually driven by risks that you just can't see at first glance. And right here, you can really see the two sides of the private credit coin. On one side, the appeal is obvious, right? This market has just exploded because it gives companies a fast track to cash. And for investors, hey, the returns have been fantastic. But then you look at the other side and you see the alarms. Now, two words here are absolutely crucial: illiquidity and overvaluation. Illiquidity just means you can't sell these loans easily. It's not like a stock. You're pretty much locked in. And overvaluation, that's the big fear, that the prices of these loans are all pumped up and don't really reflect the true risk that a company might not be able to pay you back. And this is the critical point. For a long time, this was all just talk, stuff for analysts and economists to debate. But now we're starting to see the first real signs that these hidden risks are starting to bubble up to the surface.
And that brings us to our case study, and it features a household name you would probably never expect to see in a story about high finance.
Yep, John Deere. So how in the world does a tractor company get tangled up in all this? Well, the company's stock has hit some turbulence, and it's being linked directly to worries about the financial health of its customers. We're talking large farms, construction firms, the kinds of businesses that use this exact type of private financing to buy their very expensive equipment. This is a perfect example of a ripple effect. A potential problem in the private credit world is now making waves for the stock price of a huge public company.
So, knowing all this, what does the future actually hold? Is this a market you should avoid like the plague? Or are there still real opportunities to be found? There are definitely some potential bright spots. The absolute explosion in artificial intelligence means countless new companies are going to need exactly this kind of fast, flexible funding. And on the bigger economic picture, if the Federal Reserve starts cutting interest rates, that would act like a pressure release valve on the whole system, making it easier for companies to pay back all these loans. But, and this is a big but, you have to weigh that against the reasons for caution. Those core risks we talked about, illiquidity, overvaluation, they haven't magically disappeared. And here is the biggest unknown of all. This market has done most of its growing during a pretty long stretch of good economic times. How it's going to hold up during a real sustained downturn, that is completely untested territory. So when you're looking at this cocktail of genuine opportunity and some pretty serious unknown risks, what's the right move? What do you do? Well, the advice from our source material really boils down to these three clear steps. First, stay informed. And that means more than just reading headlines. You got to track the actual default rates in these loan portfolios. Second, stay cautious. You have to remember you can't just dump these investments on a bad day. The exits are few and far between. And third, prioritize diversification. That's just a smart way of saying make sure your entire portfolio isn't too heavily loaded into one single opaque market like this one. So, in the end, it all comes down to this one massive trillion-dollar question. Is this booming, semi-hidden market the next great engine for innovation and growth? Or are we watching the early tremors of the next financial crisis? The final chapter isn't written yet, but just knowing the right questions to ask is the first and most important step to being prepared for whatever comes next.